Candlestick formation basic. Similar to classic chart patterns, candlestick formations are a group of patterns that repeat through history and give us a potential indication of future points of an instrument. These patterns are much easier to learn. You can master everything in less than one day and need only know how a Japanese candles chart works. Candlestick patterns that have good chance of working in our favor are engulfing, hammer, doji, harami, hanging man. An engulfing pattern is a reversal pattern that appears in the last stage of a bullish or bearish trend. The pattern consists of two candles. The first candle is characterized by a small body and is followed by a second candle whose body completely engulfs the first candle. We have two images on the left. The first one would be engulfing, suggesting a potential bullish move, and the second one, so when the second candle is red, should be engulfing candlestick that suggests a potential reversal to the downside. And just keep in mind, this kind of the candlestick, you want to search in the middle and ending stages of the trend only, not at the beginning. Hammer candlestick. The hammer is reversal pattern that appears at the end stages of a bearish trend. The hammer pattern is formed alone, with only one candle required. The hammer is formed when the currency moves sharply lower after the market opens, but rallies at the close well above the intraday low. So the only part that you need to understand here would be that before the hammer candlestick, you should see at least one red candle, like 3, 4 more better, but one minimum. So ending cycle of the bearish trend. Harami candlestick. The harami is another reversal pattern that consists of a development of two candles. With the first candle, you will notice a white candle that closes near the bottom of the range and a second candle which has significantly smaller body than the previous one. So it's exactly the same as engulfing, just reverse those two candles. So in harami, the first candle is larger and the second candle open and closes below that first candle body size. Doji candlestick. The doji is one of the most commonly spotted patterns. It occurs after strong momentum, either way up or down, when the market is ready to change. Doji candles occur when the market can't decide where it's heading next. It opens where the market opens and closes at the same level. So what you're looking in a doji candle is usually going to be the candle where open and close are more or less at the same level. You can give a few pips, that's fine, but don't add more than, let's say, 2-3 points. Hanging man candlestick. The hanging man is another candle reversal pattern that can be seen often in the market. The hanging man is formed alone, with only one candle required. The hanging man is formed when the currency moves sharply higher after the market open, but rallies back below the opening price at the close. We should only look for this pattern during a strong bullish market. So it's exactly the same thing as we have in a hammer pattern, just instead of looking for that kind of deformation in the bearish market, the hanging man is going to be seen in the bullish market only. So try to see at least one, if not more, green candles prior to the hanging man. And let's look at this pound dollar chart. So what we can see first here would be this, what we call this engulfing candle, since the second that blue candle engulfs a complete body of that first red candle. And after that, market moved higher. And you see, this candlestick formation happened at the end of a correction. So ending stages of that short-term trend. After that, what we can see is another engulfing formation. Same thing, same scenario. Just the candle size a little bit smaller, but overall is the same formation. Again, appeared where? At the ending stages of that downtrend. After that, price moved higher. And at the end of that same pullback, what we have is another two candle formation. In this case, that would be a Harami candlestick. Because here, the first candle is much larger than the second one. And we see that open and the close of that second candle are below that first candle body range. Market moved lower. Let's see more examples. Pound dollar, daily chart again. So start from the bottom, we have engulfing formation, where at the end of the trend, price moved higher after that. After it, we have a doji candle. We can see that market wasn't sure if the bulls are ready to push in or the bears are ready to move the candle to the new low. So we open and close around the same levels. After it, we managed to break that doji to the upside and price continued to push higher. And not long after we had that first doji, we got the second doji. So again, market stopped and paused for a while before we broke the doji highs and made a new high. After that, another doji candle. Usually it represents that pause in the market, that small pullback bar. And we want to see which side will price break first to know where we want to trade. Let's see more examples. This is dollar Swiss franc daily time frame. So what we have here first, this is engulfing pattern. The second candle is much larger than the first one. It engulfed complete body of the first candle. So market moved lower. After that, at the end of that bearish trend, we got again engulfing candle, suggesting, okay, maybe we are ready to move higher. Definitely, when you start searching for the candlestick formation, I would suggest to use a higher time frame. Minimum try 4 hour and higher. You can spot the candlestick formation on any time frame, but from my experience and my study, they are going to work best if you spot them on the higher time frame. And if you see them on, let's say, 1 minute chart or 5 minute chart, even a 15-minute chart, they can work, but the probability drop from, let's say, 65 to 70% down to maybe 50. And then it's, my view, it's more gambling if you use it alone. Okay, let's see here what we have. A strong bearish drop in the Aussie yen, and at the end of the drop, you have that hammer formation, suggesting a potential change of a direction. Definitely, I would love to see a little bit more blue candle here, but still color really doesn't matter that much to me. It looked like a hammer, so price move higher. At the end, we have more or less a 2 doji candles that tell us, okay, we don't know where market want to go next, because both candles more or less open and close around the same levels. Finally, we broke lower, and that's all. But still, if we are trading and we are in a position, let's say we are in the long position and market is moving higher, moving higher, moving higher, but we didn't reach our take profit yet, and we see that doji candle, it's probably a good time to maybe not cash out everything, but at least book half of your trade and move the stop to break even, just because you will know after the doji candle on the higher time frame that we really don't know if market is ready to move up or down until we have more confirmation. Let's see here. First of all, we got that engulfing candle. End of that bearish drop, we moved higher. After that, we got the 2 doji candles in a row, again suggesting we don't know what's going to happen next until that third candle, that first candle after the 2 dojis closed. Then you get information, okay, market want to move lower. There is no question anymore, and we continue to see a drop down. After that, we have a hammer here. No, it's not the hammer, because what we said, we want to see the hammer formation in the bearish market, not bullish market. So this third candle is wrong. Let's see here. At the beginning, we have that engulfing candle. Fine. Moved higher. At the end of that trend, another engulfing pattern. After that, we got the doji candle. Few times a market dropped down. After that, another doji candle. And I think that only after that strong break, after that final doji candle, and the next day close, we would tell to ourselves, okay, there's probably a chance that we are ready to continue to move down. And at the end, we have another engulfing formation. It's not ideal to see it like this in the middle, but still it's fine, just because we know that, let's say, trend is bearish and this is the end of that smaller pullback, so it's fine. So they just confirm that market want to continue to move lower. Okay, let's see here. We have a doji candle at the end of the cycle. Market moved lower, so first candle closed, we know market want to change the direction. At the end, you can say easily it's an engulfing candle, or if you say it's a doji candle, you really won't make any difference. In both cases, you would know that market is ready to change after that first blue candle close. After that, we have that hammer formation, end of that bearish cycle, and we move higher. After that, we have a harami pattern. So just inverse of that engulfing. We have it at the end of that bullish cycle, suggesting, okay, a potential reversal, and market moved lower after that. Candlestick pattern conclusion. Candlestick formations can be a really helpful tools for every trader. We can use them as confirmation for entering the market early or late as early exit point. For best results with candlestick patterns, we suggest only using higher time frames, 4 hours or higher. Important: never try using candlestick patterns as a standalone trading solution. Our test suggests that they can be profitable only when used with additional confirming indicator. So what that means is that you want to know about the candlestick patterns and you want to trade them. But if you want to have a good win rate, you need to add something, at least add one thing like the RSI, MACD, stochastic, or even moving average. But you need to add one more thing to make it worth your time. Now pull up a few charts, guys. Try to find as much candlestick as you can. Also, below on this page, you will get a small cheat sheet of all candlestick formation that you want to search. You can print that cheat sheet and have it always next to you to help you to find them faster.